Assalamu alaikum. Good morning. Um, Today, inshallah, we are going to study our last topic in the Global Strategic Management course. It will be about the global financial management. We will see some financial issues that the companies that work in the global market may face. Maybe most of these terms and concepts you are familiar with from the finance subject, but we will focus on the managerial issue, how the companies can deal with these issues in the while working in the global market. As we know that the global finance changed over time since the 80s, and there was some traditional financing instruments like the international promissory notes that exist in the Middle Ages. Then we have different types of facilities has been opened to firms operating across the world, ranging from hedging techniques to cross-border listing and swaps. This is some terms that I think you can understand or familiar with, but we will explain it also shortly in this lesson. So in this chapter, we'll focus on the firms that operating globally may face some challenges related to the management of their cash flows, the cost of their capital, and their exposure to risks. So we will understand the nature of the risks that may generate by the currency fluctuations, and also to understand the hedging techniques available to manage these currency fluctuations. We know these currency fluctuations, the changes in the value of the currency towards the other currencies in the exchange rates and so on. Also, to compute the cash flow of an international project and assess its economic return using either the adjusted present value method or the cost of capital adjustment method. Also, we'll understand the benefits of the cross listing. We will see what is the cross listing approach, and to understand also the benefits and the pitfalls of the raising debt internationally, and finally to understand the mechanics and know-how of the various instruments of trade finance of global companies that are related to export and import and so on. So this is our topics in this chapter. We will see the main issues in the global financial management, then the currency fluctuations and hedging towards them, and the international project finance deals. You may remember the project finance deals in our course of project finance in the previous semester, and also the global capital structure related to the equity and debt and so on. And finally, the trade finance and the risks that may face the companies during export and import and so on. So now we have the main key issues on global financial management. We have four central issues discussed in this chapter: the currency risk, the exposure and hedging, how to protect the company, how the company protect itself against the currency fluctuations, also the project finance, how to evaluate the international investments and how to finance them, the capital structure, how to take advantage of global financial market to raise equity and to deal with debt, and finally the trade finance, the traditional instruments of financing exports and imports of goods. So this is the four key issues in the global financial management as we explained earlier. First, let's see the first topic, the currency fluctuations and hedging. Currency fluctuations can affect the economic value of the companies which operates globally. As we can see here, the variation of measured currencies against the US dollars. We can see from the first scale the US dollars to the sterling pound. You can see the fluctuation, the ups and downs in the exchange rate of the foreign country to the US dollar and so on. All these currency fluctuations, especially for the companies which operate globally in many countries, so it deals with many currencies and so on, may face some or affected the economic value of the company itself by three ways: the strategic exposure, the transaction exposure, and the translation exposure. When we talk about the strategic exposure, we can see that the change in the competitive advantage of a company in terms of future cash flow owing to increased or decreased costs arising from changes in currency values. So you can see that the cash flow, the future cash flow, the expected cash flow of the company may be affected by increasing or decreasing if the costs rise because of the changes in the currency values. Also, the global firm is better positioned to deal with the strategic exposures because of their diversified market portfolio and abilities to relocate production facilities. So there is some benefits from working globally. So how can company hedge towards this kind of risk? We have some hedging techniques like the hedging with strategic product positioning. Strategic product positioning. We mean the developing of the products or the service for price insensitive markets through differentiation. And also the hedging with geographical positioning by balancing sales and production assets within exchange zones. And finally, the sourcing in low-cost countries. For example, countries with relatively low wages despite having strong currencies. So companies can use the low-cost countries in their natural resources or human resources for hedging toward this risk. The second risk is a transaction exposure, which means the positive or negative changes in short-term cash flows. Now we are talking about the short-term cash flows during the transactions. This is what we call transaction exposure. So it may be these changes may be positive or negative in the short term. So owing to existing financial or commercial commitments on this company. So we have also some hedging techniques, which includes this type of contracts I think you are familiar with in finance, in the bonds and stock markets and so on. We have the forward contracts. We use also this for currency fluctuations risks. Forward contracts by which buying at a fixed future date, a fixed quantity of a given currency at a fixed exchange rate. You buy a fixed quantity of currency at a fixed exchange rate, but for a fixed future date, which is called the forward rate, and it is most common hedging technique used by corporations. Also, the future contracts, which is similar to the forward contracts, but standard financial instruments traded in recognized future markets. We have also the options, which is contracts allowing one to sell or buy a currency at a given exchange rate, which is called the strike price, at the end of the maturity period. And finally, the currency swaps. Swaps when one company borrows in currency X but repays in currency Y, and another company borrows in currency Y but repays in currency X. So the two companies can swap their loans through a bank. There is also some non-hedging techniques for the transaction exposure, leading and lagging, and also netting. As for the payments, a company would try to collect receivables early if they are nominated in soft currencies and delay the collection of receivables nominated in hard currencies. This is for payment. For receipts, a company would try to pay early if they are nominated in hard currencies and delay payment nominated in soft currencies. This is leading and lagging. Netting, which allows treasurers of global firms which have centralized cash management to hedge net cash position for any currency that has a creditor position. Types of netting system like the bilateral netting, the netting between pairs of subsidiaries, the multilateral netting, the netting of all transactions and transfer of the net to a central. Third, or the third risk related to the currency fluctuations, the translation exposure. As the currency movement affects valuation of assets and liabilities of global companies, and this can affect market perception and hence market value of the firm. So there are two main methods of adjusting financial statements for currencies fluctuations. We have monetary, non-monetary method, and current method. For the monetary and non-monetary method, the monetary assets are translated at the exchange rate prevailing on the date of the balance sheet, and the non-monetary assets are translated at the historic rate. For example, the rate prevailing at the date they were entered in the balance sheet. Second, we have the current method, as all balance sheet assets and liabilities are translated at the exchange rate on the balance sheet date. So the income statement accounts can be translated either as the exchange rate at the date when the revenues and expenses are incurred, or at the average exchange rate of the period. So translation gains or losses are reported in a separate equity account of the parent company's balance sheet. So this was the currency fluctuation hedging. Now let's move to the international project finance deal. As we know from the previous semester, the project finance, which is the type of huge projects related to the infrastructure, mainly when we talk about the global firms, we are talking about international project finance deals, which are made in the global context. So we have here investors working in different countries. So this kind of project deals with the valuation and financing of productive investments in countries that are not the investor's country. So we have two main issues here, the valuation of the project and the financing of the project and its capital structure. So the project valuation, we have two approaches are available to take into account country risks and currency risks, which are not diversified. First, we have the cash flow adjustment, or what's called adjusted present value, which involves the following four steps. The cash flow adjustment. Okay, specific downside risks are identified, so their impact on the cash flow is calculated and the probability of their occurrence is determined. Also, cash flows are adjusted using probabilistic distribution. Cash flows are then translated into the investor's currency using the PPP, or the purchasing power parity differences, as a proxy for currency fluctuations. And finally, cash flows are discounted using the investor's cost of capital. This is how to evaluate such kind of project with the cash flow adjustment approach, or what is called adjusted present value. The second approach is the cost of capital adjustment. Cost of capital adjustment, which introduces a premium risk to the cost of equity, adjusting the risk premium by introducing a country beta to the cost of capital is argued to be more appropriate in case of investments in emerging countries where risks are not diversified. Now we have the specific project financing, the equity, how to deal with equity and debt. So equity project financing for developing country and industrialized market economies. The equity project finance is usually provided by the development banks, like the Islamic Bank, the German Bank of Development, the African Bank of Development, and so on. This international financial organizations. And we have also the debt project financing, which provided by banking institutions, development banks, also government aid or supplier credits. When provided by banks or supplier credits, debt financing is backed by credit risk insurance, guaranteed by the credit risk insurance. What about the global capital structure? The capital structure. So capital markets can be either integrated or fragmented. Integrated as a whole one and or fragmented into a separated. Integrated capital markets mean that raising money in any country comes at the same cost because it is integrated. What about fragmented capital markets? Means that capital markets still differ in their structure and costs and risks. So fragmentation can be observed in first the correlation between the movements of one country's stock exchange against an index of all stock exchanges in the world, and this measures the relative riskiness of different stock markets like a country's stock market. Third, second, we have the difference in cost of capital, the debt and equity in different countries. Then we have with the different macroeconomic outlooks of different countries. So we are dealing in this global context in different countries. So these countries have different macroeconomic outlooks. So and different risk profiles. So the cost of capital can be different in the different countries, which allows companies to benefit through this by two means: the cross listing and the international bond issues. The cross-listing refers to the listing of a company's ordinary shares on a different exchange other than its original stock exchange. Which means, for example, a company might list its equity shares on a foreign stock exchange in addition to its domestic exchange or stock market. There is some advantage and disadvantage for this approach. For the advantages, it makes the company reach wider investor base, more investors, which can boost demand and increase the demand and the liquidity of the company shares. Also creating a secondary market for the company's shares and establishing name recognition in new capital markets. Also projecting the company's name and products in the foreign country where it is listed. And finally, the potential benefit of protection from hostile takeover with a widened investor base. But there's also some disadvantage like the costs that may incur in compliance with disclosure or listing requirements of foreign exchange. Also, the volatility of the stock in one stock market can affect the volatility of the stock in another. Finally, the foreign investors can easily purchase a company's stock and challenge the domestic control of the company. Second approach, the company can benefit from these differences in the different countries. International bond issues, which means international bond market is another way in which multinationals can source new debt capital. So when markets are imperfect, international financing can lower the firm's cost of capital. For example, the euro bond financing is usually cheaper than the domestic bond financing. There is also some benefits in this for this approach, like the means of financing at lower costs, that promotes diversified investor base, and the dual currency bond assist parent company to finance its overseas subsidiaries operation. The parent company can pay off the periodic coupon payment at local currency of the parent company, but principal payment by foreign subsidiaries is in foreign currency. So this is a dual currency bond as we see. But there is a potential disadvantage in this approach, as the company may need to satisfy additional security regulations like information disclosure and so on, which is required by the overseas regulatory bodies. Finally, we have the trade finance. As we can see, there is some main concepts in the trade finance text, as the documentary credit. When we talk about the documentary credit, as when some importer, a company imports goods, mandates their bank to issue a letter of credit. This letter of credit guarantees that the exporter will pay at reception of shipping documents establishing the proof that goods have been actually been delivered to the transport company. So we have here the credit facilities offered by the export credit agencies. The export credit agencies, which is one of the very important factors in this context of the international trade financing. To these credit facilities offered by the export credit agencies to the importers and the exporters. Also have the counter trade deals that ease the cash outflow of exporters. In counter trade, the buyer pays the total or part of the contract in products or services and mostly used by developing countries that are short of hard currencies like the barter trade, the buybacks, and the bilateral clearing agreement. The barter trade, the exporter is paid in products coming from the importer's countries. The buybacks, here the supplier of equipment agrees to buy part of the output of the exporter's facilities, and a variant of buyback is counter purchase contracts in which the products sold to the exporters come from a third party. And finally, we have the bilateral clearing agreements in which the governmental level, when two governments agree to trade and debits and credit of the trade is registered in an account whose balance is cleared at the end of the agreed period. So now we finished our chapter about the global financial management. We can see some questions for this your assignment for this chapter, and also you can look up these key terms and understand when you can find more details in the textbook. This was our last chapter in our course, the Global Strategic Management. Wish you the best of luck and hope to see you later, inshallah. So, goodbye and good luck. Assalamu alaikum.